Hey everyone, welcome to the Inspired Fire podcast. My name is Chris and I'm your host. Today we have J.L. Collins joining us on the show. For those who don't know him, he is the author of the book, The Simple Path to Wealth, and he's very well known for his stock series as well on his website, jlcollinsnh.com. He is the godfather of investing to the fire community, and that's why I'm super excited to have him on the show to talk about investing, everything investing, as well as how to handle investing during difficult times like we're going through now. So before we get into that, I would like to touch on a couple of things though. I do want to announce two winners for the giveaway. So if you follow me on Instagram at InspiredFire, you saw that I'm doing a giveaway of the Simple Path to Wealth book. I'm really excited to get that book into people's hands. So today I'm giving that book away to two people, and the next episode it's going to be two or three other people as well. So just get those reviews on Apple Podcasts in. That's how you sign up for the giveaway. So just go ahead and leave your review on Apple Podcasts and send me a screenshot. So without further ado, the two winners is JF Meeks and Flex Eat Repeat. So congratulations. I'll be sending your book out soon. The other thing I wanted to mention is that there's an awards right now called the Plutus Awards. They're basically like the Oscars for personal finance. And I'm up for two categories I really hope that you guys can nominate me for. The first one is Best New Personal Finance Blog, and the second one is Best New Personal Finance Podcast. So if you can, I'll go ahead and put the link in the show notes and support me in any way you can. That's just by going there and nominating me, putting there Inspire to Fire. And again, I'd really appreciate your support. All right. So without further ado, let's get into this episode where we talk about investing with J.L. Collins and handling difficult times, recession, and bear markets. Hey, JL, thank you so much for joining the show, and welcome to the show.
It's a pleasure to be here, Chris, and I'm honored that you'd ask.
I mean, I'm super excited to have you on. I highly regard you. I put you up there in terms of Warren Buffett, Jack Bogle, and then comes you, and that's just I really mean that when I say that. But so it's an honor to have you on, and I'm excited to share with the audience your simple path to wealth and all the essentials that we need for investing and to get it right.
Well, that's elite company you've put me in. I hope I can live up to it within our conversation today.
I'm sure you will. So what got you started, and I think what became very popular for you and on your blog, was the stock series. So I think I want to start there. What made you write the stock series, and how did that come about?
Well, the whole blog came about as a way to archive information for my daughter, so that when the time came that she had an interest in this stuff, it would be available to her, whether I was around to deliver it personally or not. And then the stock series sort of grew out of that. And I think what's interesting about it, it's now up to 30 or 33 or something posts. But when I originally started it, my vision for was only the first 5. That's kind of my plan when I was creating this series. It would be a 5-part series, and I didn't really think beyond that. And the rest of the posts after the 5th one came out of suggestions and questions from my readership, who evolved my thinking on topics that they wanted to hear about and that would be worth discussing. So that's how we wound up with 30 plus.
Yeah, and I mean, they're 30 plus great posts. So that kind of led to the book. Is that correct? The Simple Path to Wealth, which I want to congratulate you on. Today's June 2020, and the book just turned 4 years old. It's made such an impact on so many people. I think you've sold over 50,000 copies, if I'm not mistaken.
Yeah, actually over 160,000.
Wow.
Yeah. So this conversation, and the book's 4th birthday was June 18th, which I just happened to notice myself a few days before it. So I marked it on Twitter and Facebook, and it, to my amazement, it has sold better each year. So each year it sells better than the year before. And I don't really do anything to promote it. I suppose the blog promotes it, and maybe having conversations like the one we're having does, but I don't do any real aggressive promotion on it. So I chalk it up to word of mouth, and it's gotten really favorable reviews on Amazon. So I think all of that helps, but nobody's more amazed at its success than I am.
Well, I mean, the simplicity of it is amazing. The content, of course, is amazing. And you've said that there's nothing really in the book that is not in the stock series. It's just more organized. Is that right?
Well, yes, except that it's not just the stock series. There are parts of the book that are drawn from the blog other than the stock series. So the core of the book is drawn from the stock series, but it's not exclusively from the stock series. But
Gotcha.
your point is still correct. There is nothing in the book that you can't find on the blog. The book is more concise. It's better organized. I spent more time polishing the writing. I'll leave it up to readers to decide whether I succeeded or not, but those are the three advantages, if you will, of the book. But by design, there is nothing in the book that you can't find on the blog. And that goes against, by the way, the advice I was given at the time, which was to be sure to put things in the book that are not on the blog so people have to buy your book.
Right.
And I kind of thought to myself, the only reason that this book exists is that I have loyal readers who have read and supported the blog, and it just seemed to me to be kind of a crappy thing to do to them to have information that they had to pay for. So that's why I chose not to do it. And interestingly, if you look at some of my 1-star reviews on Amazon, or 2-star reviews, some of the negative reviews, that's one of the criticisms is, well, this is just a rehashing of the blog. And okay, I guess so.
I mean, I love it. I think that's very honorable. A lot of people would have chosen the other route for sure.
Well, that's certainly the advice that you're given.
Yep. So let's kind of get into that, because my goal is to share with the audience exactly what your investing advice is, why I think it's so important, and really it's one of the pillars, or one of the core foundations to the FIRE community, I think. So let's just, if we can, get into some of the background and how you learned to invest. How long have you been investing? Where did these things come from? How did you become so knowledgeable in this aspect?
So you covered a lot of ground in that question. So let me see if I can remember all of it to respond, and if I don't, remind me. So I started investing in 1975, and what's mildly interesting about that, at least to me, is very coincidentally, that's the same year that Jack Bogle started Vanguard, and the same year he launched the world's first index fund, which was the S&P 500 fund. So I'm self-taught in investing. It was not my subject of study at university, and it's been an avocation rather than a vocation for me, at least until these recent years with the blog. And if I know anything about this stuff, it's because I have made every possible mistake you could make in investing. And so it's that accumulation of knowledge. I look back and I think, man, I wish I had written this book. A lot of people tell me they wish they'd read the book when they were 40 if they're 50, or 30 if they're 40, and on down the line. I wish I'd written it when I was 30, but I wouldn't have been able to write it when I was 30. I don't think I had the knowledge base to write it until when I did. But that's the evolution of it. And then the book itself looks at that microcosm of time between 1975 and 2015, which is really sort of the final stages of writing it for the illustrations. But it's a very instructive 40-year period, I think, because The market did very well in that 40-year period, but it also faced major, major challenges in that 40-year period. And the point of that is simply that the market does not need ideal conditions in order to rise and rise significantly.
Mm-hmm. Yeah, and like you mentioned, there's been a lot that happened during those 40 years. So you're pretty well known, or a lot of people know you to say things like the market will always bounce back, or the market always goes up. And that could be viewed as pretty controversial at first if somebody tells you, hey, this is always going to go up. But can you explain a little bit about why you say that to your audience?
Sure. So that is one of the statements that has gotten the most pushback that I've made, and because people delight in saying, "Well, you can't say that it will always that anything will always do something," blah blah blah. And I suppose that's true. So the big caveat in saying the market will always go up is the market will always go up as long as, and I'm talking about the U.S. market now, as long as the United States of America is a capitalist country with a viable economic system, and that it exists as a country. So if you don't believe that the United States itself has a future, then you're probably right to be cautious about my statement that the market is always going to go up. But if you do believe the United States has a future, then almost by definition, the market will recover from anything that fate throws at it. And that is the history of the market and the United States. The United States has gone through some terrible things. We're going through one at the moment, and the market always rebounds. The other thing that your listeners should understand is that when the market drops, this is a perfectly natural part of the process. The market is a volatile animal. So when the market drops 10%, that's commonly called a correction, fairly common event. Drops 20%, that's called a bear market, little rare event, but still common. When it drops 30+%, that's a crash. Not nearly as common, but certainly should never surprise anybody. I used to live in New Hampshire, and the corollary I draw is that if you live in New Hampshire, you should never be surprised by blizzards in winter. It's just part of living in New Hampshire. Doesn't mean the blizzards can't be dangerous, and doesn't mean that they're pleasant, but they should never surprise you. And nobody assumes that a blizzard, even at the worst, is going to last forever, because we know from experience it doesn't. It's the same thing with stock market declines. And if you happen to live in Florida, you can use hurricanes instead of blizzards.
I just so happen to live in Florida, so I will use that.
So it's hurricanes for you and blizzards for my old friends in New Hampshire.
And you touched on it. We are going through a difficult time as far as the pandemic. And so I kind of wanted to see what your thoughts were on that, because I wasn't invested, and a lot of people in my audience weren't invested in '08. I hear that '08 was a difficult time, of course, and I saw it, but I wasn't invested, so I didn't feel that panic or that fear. But going through this recent market correction or crash, I did get a sense of it, but I felt unusually calm through the whole thing. So I'm not sure if that is a true test of what a real bear market feels like, or what '08 might have felt like, or could it get a lot scarier?
So it could definitely get a lot scarier, and I'll talk about '08 in a second, because this one is currently playing out, and might be one of the reasons that it hasn't felt quite as scary is that while it dropped very, very sharply, it also rebounded for the most part very, very sharply. And the '07, '08 scenario was a little different. I mean, it dropped very, very suddenly, and then it kept grinding on down. So to put '08 in perspective, the market hit bottom in 2009, in March of 2009. And it hit bottom around 600, and I think it was actually 666. was the actual number when it hit bottom. And at that point, it had dropped about 50%.
Wow.
And so people look back on that and they say, well, could I absorb a 50% drop and not panic and sell and cut and run? And by the way, nobody should follow my advice unless they're absolutely certain that they won't panic sell when the market goes down, unless they absolutely accept the idea that the market always comes back and that plunges, no matter how dramatic they are a natural part of the process. Because if you panic and sell in the middle of a drop, then my advice will leave you bleeding by the side of the road. But the perspective that people need to understand is that when the market hit that bottom in March of 2009, nobody knew that that was the bottom at the time. And we all know it now, but nobody knew it then.
Mm-hmm.
Everybody that I was talking to in March of 09 was predicting that it was going to continue to drop, and by a lot more. Most of the most common predictions I was hearing from quote unquote the smart people were that it was going to go down another 2/3. Now let's put some numbers on what that looks like and how it might feel. Let's suppose you started before the drop with, and I'm choosing these numbers to make the math easy. Let's say you had 1.2 million in your portfolio. Well, come March of 09, you've now got 600,000 in your portfolio. It's been cut in half. Now you've hit the bottom, but you don't know that. And everybody around you is telling you it's going to go down another 2/3, which is going to take you to 200,000 from your 1.2 million. So the question then becomes is how do you feel about it at that point? Are you really going to stay the course at that point? And that's what a really ugly market looks like. This one, at least so far, nobody knows, whether the drop is over and we're going to continue our bullish run or whether this is what they call a dead cat bounce. Nobody knows the answer to that. I know there are a lot of people who claim they know the answer, but nobody does.
Yeah.
But we'll see. But that's sort of the thought process, the mental exercise to go through to evaluate what your real tolerance for these things might be.
Yeah, and you're a big proponent of owning VTSAX and having some bonds as well on the side. Just depending, maybe what would you suggest? I forget, 25% or so.
Well, I think it depends on where you are in your life. So I kind of divide our financial lives into wealth accumulation and wealth preservation. And in the old days, it used to be that was also largely age-based, right? So, you worked for 40 years or whatever until you were 60, 65, and then you retired. And so that was your wealth building phase. And then when you were old, you were in the wealth preservation phase. But in the financial independence movement, of course, there are a lot of people who are retiring a lot younger than that. A lot of people who achieve financial independence who might wind up going back to work after a while or founding a business and earning money again. So you might go in and out of those or back and forth between those two phases. So basically what I say is when you're in the wealth building phase, by that I mean you're earning money. You have an income either from a job or a business, or you are in some fashion trading your labor for money. And so you have a steady cash flow coming in. And in my world, you take a fairly significant amount of that cash flow and you set it aside. You live below your means to free up that capital to invest. And in that stage, I encourage, and this is the stage my daughter's in, by the way, I encourage her to be 100% in VTSAX, which is the total stock market index fund that Vanguard puts out, low cost, owns virtually every publicly traded company in the United States. What that ongoing cash flow from your work provides is a smoothing effect on the volatility of the market. For instance, I think it was April when she made her monthly contribution to her VTSAX account, I noticed that it bought 19% more shares than the one the month before, because of course the market had plunged.
Mm-hmm.
That's another key point, by the way. When you're young and you're building your wealth, a market drop like the one we've had this spring is an absolute gift, because
Yeah.
as long as you stay the course and keep investing, you are now buying those shares at a lower price. So that effect of having that money going in every month smooths out the volatility of the market. Now, when you stop working and that cash flow from your labor stops and you're living on your portfolio, you're going to want something else to smooth out the ride. At least most people are. Some people are going to say, well, I don't care about that. And the research indicates that 100% stocks long term gives the best performance. So I'm just going to stay that route.
Mm-hmm.
Nothing wrong with that, as long as you understand you've picked a volatile road. But most people want to smooth it out a little bit, and that's the role bonds then provide. So if you add bonds to the portfolio, then you have a counterbalance to your stocks. You also have a supply of capital to invest when your stock part of your portfolio drops, and you'll do that by bringing your allocation back into line. Now, as to the question as to what percentage ought to be in bonds, that really depends on how much you value performance of your portfolio over time against how much you value reducing the volatility and
Mm-hmm.
maybe sleeping better at night.
Yeah.
So, anytime you add bonds, you reduce volatility, but long term, you also reduce performance. Anytime you add stocks, you increase performance long term, but you also increase volatility. And it's a very individual choice as to which of those things is more important. And that will determine your asset allocation between stocks and bonds. The one caveat I'd put on that is that if you let your stock allocation drop below 50%, the 4% rule begins to not work anymore. And we can talk about the 4% rule later if you'd like.
Yeah, definitely. I'd like to get into that. But while we're on the topic of VTSAX and smoothing out the ride, etc., I think it's important, like you mentioned, it is personal. So you do have to see what your risk tolerance is. At least for me, from a personal uh, point of view, or my opinion, or what I've gone through is I owned a stock called AMD when I first started, and I thought that stock was going to just keep going higher and higher. And then one day it dropped by 25% in a single day. And luckily I didn't have too much money in it, but that's when I realized that I can't stomach stuff like that. And for a single stock, there's too many thoughts that go into my mind, which is that company, that one single company could go to zero and I could lose it all. But so one thing that gave me comfort with VTSAX and just a stock market index fund is that if one single company or two goes to zero, the index as a whole still survives, and you call it self-cleansing. So I thought that was very powerful because it gives someone the confidence to see a dip or a correction and not feel that it's going to zero, because you know that all the companies within the index is not going to go to zero. I mean, that would be apocalyptic. Is that is that what you might gather from the VTSAX? Like, do you think that would help individual investors do it on their own?
I think you're absolutely right, Chris, and I think that's very well said. I take great pride in that term self-cleansing, by the way, which I created. So let me elaborate on that a little bit, because I don't think I can add anything more to what you said so well. But by self-cleansing, what I mean is the index, as you point out, holds a lot more than one company. As I mentioned a moment ago, it holds every publicly traded, or virtually every publicly traded company in the United States. That's around 3,600 companies. Now, some of them, by definition, because our capitalist business system is a dynamic system, some of them are going to fall by the wayside. They're not going to succeed. They're not going to work. They might succeed for years and then fall by the wayside, which we've seen as the economy changes. And those ultimately they won't even go to zero for our purposes because they'll fall off the index before they get there, but they could drop dramatically. And of course, I suppose in one sense it's a bad thing. It's healthy for the economy. But the other side of that is there are companies that will do spectacularly well. And while the worst thing that can happen to a company is it goes completely out of business, goes to zero, loses 100%, well, the upside isn't limited to 100%. So in a sense, you have a positively rigged system. The worst that can happen to some of the companies you own in the index is they'll lose 100%. The best is they'll gain 100% or 200 or 500 or 10,000. So there's literally no upside. And it's that constant self-cleansing of the index that gives me the confidence to say the market will always go up, even though it'll have dramatic drops periodically, which, as we discussed, are perfectly natural. The market, as long as there is a United States with a viable economy, the market will always recover from those things and always go up. Because for VTSAX to go out of business like your one company would require basically the United States to go out of business. And as we said at the beginning of the conversation, if you believe that's going to happen, and there are people who believe that, then you shouldn't be investing in the stock market, and you shouldn't be following me or my simple path to wealth. You should probably be stocking canned goods and ammunition.
Yeah, building a bunker somewhere.
Yeah.
Yeah, I think it's important to try to decide how you're going to invest based off of the odds. You know, what is most likely to occur, and like you said, over the last 40 years or plus, we've gone through a lot of different things, and you know, some things I didn't witness, and I don't know how bad it was, but you know, wars and inflation, etc. So if we've gotten through that and the market has only roared higher, just by percentages, I'd rather be on the side that you know, the United States and capitalism will survive. I'd rather bet on that horse than on the black swan, you know, cryptocurrency, I guess, possibility.
Well, I think again, you're right. When black swans are do happen, but by definition, black swans are very, very rare events. And by the way, black swans, and you might say that COVID-19 is a black swan, don't necessarily destroy the system. I mean, they can create havoc. The economic collapse in 0708 was a black swan in a sense, but we survived it. The market always goes up. And that 40-year period, by the way, in your show notes, you might want to link to a post I wrote called Time Machine and the Future Return of Stocks. And basically it was a little thought exercise I had fun with, and said, imagine we were all together back in 1975 when I first started investing, and that was in the age of stagflation, which has certainly been the worst economic thing in my lifetime, which was in the 70s into the early 80s. If you were all speculating, well, you know, what do we do? Should we invest in the stock market? And that was a really long, bad stretch for the stock market. And then the thought exercise is, well, I just came back from 2015 in my time machine, and I can tell you what happens in the next 40 years. And I go through the litany of all the terrible things that happened in that 40-year period. And of course, my little group in 1975 said, man, I'm not going near the stock market knowing all that. Well, the stock market posted almost 12% annual gains on average during that horrible 40-year period. And if you go back even further, you know, I just picked that 40-year period because that's when I started investing. But, you know, the stock market has survived world wars and Great Depression and survived the Civil War for that matter. So, you know, there are a lot of horrible things that the market has survived. Certainly impacted the market at the time, but as I say, and I think it's part 2 of my stock series, the stock market always goes up.
Yeah. And yeah, so once we, you know, establish that VTSAX is the way to go, or if S&P 500 index fund with low fees is the way to go. I mean, the ideal scenario would be to just invest regularly, make it automatic if possible, and just never to look at it, never touch it. And in 20 to 30 years, then you can take a peek and then be very, very happy with your results. So that's the ideal. Uh, but then there are people who, like myself, for example, see a recession or see a crash and want to take advantage of the lower prices. What I found myself doing during this crash is waiting. I had a little bit of money and I waited for it to continue down, and in each tier I invested to a certain point where I didn't have any left, and then it kept going lower. So I had to, so I wrote a post and I would love your thoughts on it, but I kind of thought that it would be a good idea to put in a system during those times, because although we're not going to sell, that would be the worst idea. There's not much written about how to handle investing when it's falling like that. Do you have any thoughts on or suggestions? What do you think when it comes to doing that? Should you just continue? Should you push it all in and just say, we can't time the market, so we don't know? What do you think?
Well, I would probably say exactly the last thing you said. We can't time the market. We don't know. So what the market is doing has no influence in my investing. I think the time to invest is when you have money to invest. And I pay no attention to what the market's doing, whether it's going up or whether it's going down. I understand the impulse to try to do what you're describing, particularly when it's going down. And to do that, though, by definition, it means that you have kept money to the side to have dry powder in order to do that. And the problem with that is the market goes up much more often than it goes down. So I have an article about why I don't like dollar cost investing. Now, dollar cost investing is different than the kind of routine automatic investing we talked about from the cash flow you have coming in from your work, right? And I guess that's kind of a dollar cost investing thing, because you're putting in an amount every month on a reliable basis. But you're doing that because you don't have any other choice. Dollar cost investing, a lump sum, is where I don't like it, because market goes up 3 out of 4 years. Now, problem, of course, it doesn't go up 3 years and then down a year and then up 3 years. It's not that regular. But on average, it's 75% more likely to go up at any given period of time than to go down. And by the way, you can't predict. There is no market timing that. So the fact that the market may have been going up and up and up for a long time, as it had been until the beginning or into the beginning of this year, doesn't mean that it's about to go down. It could just as easily continue to go up. And by the same token, when the market began to plunge, I had a lot of people commenting on my blog and the comments when I was writing posts saying, well, obviously the market, because COVID is, it's different this time. And obviously the market is going to go down much more than 30% that it's already down. Well, of course, the market didn't do that. It turned around and marched promptly back up. Some wag once said the market will do whatever it takes to embarrass the largest number of people. That's probably the only reliable thing on it. So I don't think you can predict anything about what the market's going to do. I certainly can't. And the problem with strategies trying to do that means that you have to hold capital to the side in order to have it ready to invest. And the problem with that is then that's unproductive capital that 75% of the time would be earning you a better rate of return.
Yeah, and thank you for pointing that out. I agree. I think the right decision is that, of course, it's just so interesting how behavior affects our decisions in investing. And I mean, I obviously know that it's not a good habit to watch CNBC every morning at 9:30 when they ring the bell, but I still do it anyways. I don't know why.
It's a very bad habit.
Yes, it really is. I need
very
to stop.
Dangerous to your wealth.
But yeah, we've established we cannot time the market, and it's a losing bet to try. You have to be right twice, as you've mentioned in your articles.
In the midst of the COVID plunge, I was just seeing so many people comment about with absolute certainty about how much further the market was going to go down. I put a tweet up at the time saying, I've noticed there's a new symptom of COVID, clairvoyance. Because everybody suddenly seemed to think, well, not everybody, obviously, but so many people seemed to suddenly think that they could see the future as it happened with the stock market. And of course, the stock market, true to its ethic of embarrassing the largest number of people, didn't do what everybody expected it to do. And then what was really interesting to me, by the way, is all those commentators were scratching the head and scratching their heads and talking about how the market was wrong to be going up.
Right.
It's not, I mean, that's like saying, the blizzard is wrong to be dropping snow. It doesn't care what your opinion is. The market doesn't care what your opinion is. And, whatever the market does is what the market does. It's not, by definition, it's not right or wrong. It just is what it is.
Mm-hmm. Yeah, we clearly saw that. I mean, there was so many signs pointing for it to go down, and it just defied all that and said, we don't, the market didn't care. And now it's back up. We'll see where it is. We all think it might go up or down, and it'll do the opposite. So I think what's important too is to build these type of obstacles to, because it's human nature. I think you've mentioned before, we're kind of designed to not do the right thing when the market is going up or when it's going down. Our natural instincts are to do the wrong thing. So having these barriers in place is important. And one barrier that I put for myself is the market crash meditation video you made. So I'm going to put that in the show notes because I want the audience to check that out. I mean, that is like right there on my favorites, so that if there's ever the time that I want to sell, I know I have to watch that video first.
Well, that's probably I had fun doing it. That came out of a suggestion from one of our Chautauqua attendees. So that was a lot of fun to put that together. And we put it together last summer when the market was, of course, rocking and rolling, and there was no end in sight. And but I can't predict the market, other than I know it's volatile, and I knew at some point that video would have a reason to exist.
Yeah, it's great. And so, like I said, I think everybody should check it out and have it there just in case. So jumping into a couple of other posts that you have that are very popular, so, pretty controversial as well, is the house. A house is a terrible investment. So can you explain why you wrote that post? What do I read it and I tend to agree, but if you could just explain your point of view.
What's interesting about that post to me is it is the single most popular post that I've ever written, based on the number of views that it's had. It's the post that's gotten me the most love, and it's the post that's gotten me the most hate. So homeownership is, as I say at the beginning of that post, James Altucher had once said that homeownership is the American religion. And you don't criticize the American religion without generating a fair amount of hate. What's interesting to me is I kind of did that post a little bit tongue-in-cheek. It was one of the easiest posts in terms of time and effort that I've ever written. I mean, it was just kind of, this is a little bit fun. It came out of a conversation I'd had at some event I'd gone to with a woman who was encouraging her young son to buy a house, and he had no, he wasn't married, didn't have kids, young single guy that, I don't know, it just seemed to me there's no particular reason to own a house at that stage of your life. And so I just went through the litany of again, tongue-in-cheek, of what the worst possible investment, if we were to sit down and think about what are the characteristics of the worst possible investment, and then you list them, and of course they're all characteristics of buying a house, and we'll let people read the post and decide for themselves.
Yep.
But I hasten to add that I am not against owning houses per se. I've owned houses for much of my adult life. What I am against is the real estate industry propaganda that it is a good investment, or that it's commonly a good investment, because it's not. It's a lifestyle decision. I never bought a house deluding myself that I was making a good investment. I was making a lifestyle decision. I bought houses because that was the lifestyle I wanted to have at the time, and I bought houses I could easily afford. And I think that's critical, is to buy the least house that meets your needs. And again, I shouldn't even say needs, it meets your wants, because houses don't fulfill needs, they fulfill wants. And that's great if you can afford it and buy it from a position of what I call a position of power, which means that it takes up the least amount of your resources to buy the house that you need. So I've always bought less house than I could afford. And it's always been because it served the lifestyle I wanted at the time, and I could easily afford it. And if from that measure, by all means, if you want to buy a house, buy a house. Just don't fall prey to the propaganda that you're making some great investment. You might get lucky. There are times when certain neighborhoods and certain parts of the country, the housing market explodes, and of course you hear all those stories from people who have benefited from that. But then there's stories like Detroit, where everything collapses totally, and buying a house means you lose everything. So, and you tend not to hear those stories so much. People don't brag about that, the cocktail parties.
Yeah, yeah.
So it's a caution. It's not anti-house so much as a cautionary tale.
Yeah, and I think that's great advice for anyone, because I mean, maybe I need to stop watching TV, but I love HGTV, and I see too many young couples getting into a larger house than they should. But you're brought up to believe that renting is. I was told at a young age, renting is throwing my money away, or it's giving money to the landlord when you could be, paying off the house yourself. So I think that propaganda, like you said, is rampant, and it's the American dream to own a home. But sometimes you have to, like you said, think about whether it makes sense for you.
Mm-hmm.
And it does put you down. It roots you into a specific location where, maybe if you needed or found an opportunity somewhere else, you really can't take advantage of that.
Right. Well, when you buy a house, you give up a lot of flexibility that
Mhm.
you have when you're renting. But I think one of the most common pushbacks that I get, and people, if they go to that post that we're describing, they read it, and there are probably more comments on that post than anything else I've ever written. And you hear the both pro and con, and the people arguing in favor of houses. One of the most common arguments they make is, well, owning a house has to be cheaper than renting, because your landlord is building all of his costs into what they're renting to you, and plus a profit for him or herself, and therefore by definition it has to be more expensive to rent. And that's simply flawed thinking, because rents are not set by the landlord's costs. Rents are set by the market.
Mhm.
And if you talk to real estate investors, one of the that know what they're doing, one of the things that they will tell you is, you make your money when you buy the property. You have to buy a rental property very, very carefully, and in only certain areas, because there's only certain moments and places where owning rental real estate is profitable. And there are many people who don't follow that. And there are many opportunities. You can go to Toronto now and rent beautiful condos for a fraction of what it would cost you to buy them. You can go to a lot of major cities where the real estate market has dramatically inflated prices, and rent space for dramatically less than you would pay for it. So this idea that by definition it's going to be more expensive to rent because landlords build all their expenses into it is just nonsense. I mean, absolute utter silliness. And but it's sort of, I don't know. I guess it's appealing thinking, but it's shallow, and it doesn't take into this account the simple fact that rents are not set by landlords; they're set by the market.
Yeah, and your primary house or primary residence shouldn't be treated as an investment. But getting into actual options for possible investments, you mentioned rental incomes or rental properties. Um, just wanted your quick thoughts on what you thought about REITs or gold, because you hear a lot of talk about them and then hedging versus inflation and things like that. What's your perspective on that? Is there room for gold or REITs in a portfolio?
So before we go on to that subject, let me make one last comment on housing and what have you, just to be clear to anybody who's listening. There's a thing called house hacking,
Mm,
which there are many ways to get into a house that can be profitable. And house hacking, where it simply means you buy a house and you rent out some of the rooms or what have you. So there are strategies that work, but now you're turning it into an intentional investment. That makes all the difference. Anyway, having said that, um, I used to own REIT when I first started writing the blog. REITs were part of my portfolio, and I held them as an inflation hedge, and with the idea that in periods of high inflation, real estate is one of the things that tends to go up. But as I looked at it more closely, uh, real estate's actually not that great inflation hedge. It's not bad, but it's not great. And it's no better really than owning stocks in general. And of course, when you own something like VTSAX, REITs are part of what you own. By the way, a REIT stands for Real Estate Investment Trust. So it's simply it's like a little mini mutual fund that invests in some kind of real estate. It might be residential real estate, might be commercial, might be a combination of those things. And anyway, it allows you to own real estate without the headaches of having to manage it yourself. And I owned it for the inflation hedge, but the more I looked into it, the more I realized that it wasn't that great an inflation hedge, and I already had that inflation part covered with my basic stock portfolio. So at that point, I dropped REITs, and I actually have a post on the blog. If you use the search function on my blog, you can put it in the show notes, called "Why I Stepped Away from REITs," that goes into that in detail. As for gold, I've never, I've never particularly, I've never owned it as an investment. I guess I understand the appeal, but gold is dead money. I mean, it's a classic case where you are buying something, hoping that somebody will pay more for it in the future. And I don't see any great benefit to it. I've never seen anything to convince me that it's a great inflation hedge. Sometimes it works, sometimes it doesn't. Um, and there's two kinds of buyers of gold. There are people who buy it in a portfolio to sort of balance out the volatility of the portfolio, and they might hold gold stocks, for instance, to do that, or things like that. And then there are people who are worried about Armageddon or the total financial collapse of the economy, and they're buying gold to have something tangible to hold their wealth in. I think the problem with that is that if we really have an event like that, it's going to be very hard to use your gold as a commodity for purchasing things that you might want or need. And if we have a really major collapse, then the people with the guns are just going to take your gold away from you if it has value. So yeah, I've never held it, and I don't see a great. I think it's the kind of thing that you buy because you are guessing that sometime in the future people are going to pay more for it than you paid for it, and that's kind of like predicting what an individual stock's going to do.
Yeah.
You might be right, you might be wrong.
So yeah, I wanted to propose it because I've heard it thrown out there a lot, and I kind of wanted your thoughts and kind of almost to debunk it. I'm not a believer in gold myself. I agree. I think that it doesn't produce any value, at least with the stocks. You're owning companies that earn profits and they pay dividends, etc. The gold isn't really. I think Warren Buffett mentioned it as well. If he'd rather own a farm than gold, because farm can actually produce something, but the gold just sits there.
Yeah,
Um,
I would agree with that, and I think that sometimes people who are making the case for gold uh, point, they express concern about the dollar, and they point to our enormous national debt, and the possibility of the dollar dramatically dropping in value, being devalued, and I think that's a genuine concern. I mean, that's something that genuinely makes me nervous, is this enormous debt that we're piling on,
mhm.
and what it might mean for the dollar going forward. But I don't think gold is necessarily the solution for that. I would rather own stocks. If I'm worried about cash, dollars, I'd rather, as Warren Buffett said, own farmland. I'd rather own companies. And of course, when you own VTSAX, you own a piece of actual operating companies.
Mhm.
That's what I would rather exchange my dollars for than some metal that is going to sit in a vault somewhere.
Yeah. Thank you for bringing that up because that's something that I mean I've worried myself, and I just don't understand. I feel like there has to be a tipping point with our national debt and with the Fed's involvement. I mean, with the pandemic, I don't know how many millions or billions were pumped into the market. So you hear things like that, and it's concerning. But I think you hit it right on the head when you said if you own stocks, that's one of the best ways you can just prepare, I guess, for that.
Yeah, I think so, and I think that if people want something to worry about and want something to take action on, or I think our national debt is where young people should be focusing their attention. It's amazing to me that there is not a single politician who even talks about it, and it's very rare that you see interviewers when politicians are talking about various spending programs. And COVID was, I think, $2.2 trillion, the package that they put in place for COVID, and they've been talking about additional packages for trillions more.
Hmm.
I think I read somewhere that the debt this year alone is going to be $10 trillion
Wow.
added to the national budget. And I've heard people advocating for these things saying, well, this is an emergency, and now's not the time to worry about the debt. Now's the time to deal with the crisis. And okay, I get it, but I would like to hear a little more about how you're going to deal with the debt, and especially for people in your age group. And it was the same thing, by the way. The government threw a ton of money at the problem in '07, '08. And then we had, from that time period until the beginning of this year, a terrific run, and we ran up more debt.
Hmm.
I
Hmm.
mean, we went deeply into debt to finance World War II. But when World War II ended and the good times came back again, that debt was paid down. Well, in '07, '08, we put a lot of money in to solve that problem, probably the right thing to do, in my opinion. But then we had a decade plus of wonderful times, and we did nothing but spend more money. And now we're in another crisis, and it's just, um, yeah. I'd like to see politicians being asked a whole lot more intense questions about how are you going to pay for all this, and how what is going to how is this going to be handled going forward. And it's not going to matter to me. I'm an old guy. I'll be dead. But it's going to matter to you, Chris, and a lot of your listeners, I would think. And those are the questions I'd be asking the politicians.
Definitely. I think it's important and for politicians to be fiscally responsible. I mean, I know it's not what necessarily gets votes, but it's what's right. So,
Well, the only reason it doesn't get votes is because I think voters don't see the problem.
True.
And, they're not financially savvy enough to see the problem. And politicians know that they'll get more votes by promising programs that give you stuff
Right.
than any financial responsibility. So, you know,
Well, yeah, we'll see what happens with that. And I think switching topics to something a little bit more uplifting, I want to talk about FU money because you have brought FU money to the forefront in the fire community. That's where I originally found it. And you made a video on it as well, which is like, I think you should, what do they give, Oscars or Grammys? You deserve one because that was amazing.
well, thank you. That was an enormous amount of fun to do. That also came out of Chautauqua. When I saw that movie, The Gambler,
Hmm.
and which stars John Goodman. By the way, it's not a very good movie, but there's this wonderful scene in it with John Goodman where he's talking about FU money, and in my post when I did my version, I have his version there. For the moment I saw that, I knew that I wanted to rewrite it a little bit to my ethic, but that I wanted to record it. But I didn't know anybody at the time who knew how to make films, and went to one of our Chautauquas, which are these annual financial retreats that we hold. And sure enough, there was a couple who were filmmakers who attended. And I was living in New Hampshire at the time, and they were down around Boston, just an hour away. So they graciously came up and made it happen. And it was a lot of fun.
Yeah,
Not suitable for work, as the saying goes, by the way.
yes, exactly. And I almost opened it up at work, but I said, let me listen to it at home, and I was laughing so hard, so that was a good one. Um, and you brought up Chautauqua. What's can you give the listeners and the fire community an update, or what's going on with that this year, or if there's
Yeah, so maybe I'd real briefly tell your listeners what it is, because it's
Yep.
very possible there are people out there who are wondering what's this Chautauqua he keeps referring to.
Yep.
So Chautauqua is an event I created back in 2012. We held the first one in 2013. We've done it every year since, until this year. We've had to put it on hiatus because of COVID for this year. But basically, we go to my concept behind it was to go to a cool place, hang out with cool people, and talk about cool stuff.
Sounds cool.
And that sounds cool. And by the way, all three of those things are my definition of what a cool place is, who cool people are, and what cool stuff is. It's a very selfish kind of thing. But fortunately for me, I was talking to my partners, Al and Katie, who help run it, and they were telling me that we now have 4,000 people on our mailing list for this.
Wow.
And what's interesting about that is one of the parts of the magic of Chautauqua was we limit the attendees to 30 people at any one event, and we only do 2 or 3 of them a year when we're doing them. So, less than 100 people a year get to go on these. And it's just first come, first serve. But yeah, we go to some cool place. We are currently scouting Croatia for next year.
Nice.
And, if we can find the right venue, the right cool place, then we'll go there. And by definition, Chautauqua seems to attract cool people. And it attracts, and I've written a lot about Chautauqua over the years, and you can find that on my blog. There's a little subject thing on the right-hand column, and Chautauqua is one of them. But one of the cool things about it is you could not ask for a more diverse group of people based on any kind of diversity measure you want to look at. I mean, certainly by gender, we have men and women, by sexual orientation, by race, by religion, by age, by wealth. We've had some extraordinarily wealthy people. We've had some people who are just at the beginning of the journey, but they all come together and get along famously because they all have this FI thing in common, whether they've achieved it or they're just beginning or they're somewhere out on the journey. And it's a really cool thing to see, and it attracts really, really interesting people. And so Christy and Bryce, who are another part of the team and speakers at it every year. They write Millennial Revolution, and they're nomads, and their life now, because they've been part of this for, I don't know, they came on board I think in 2017 maybe. So their life revolves around visiting Chautauquans that they've met and helped as they travel around the world. So yeah, it's a really cool thing, and everybody who's ever attended has told me that it's either one of the best weeks of their life or the single best week of their life, which is very gratifying. And the coolest thing about it is, from what they tell me, is they get for maybe the first time to meet and hang out with people who get it. They don't have to explain themselves.
Yeah.
And most of us on this FI journey it's not supported by the people in our day-to-day lives, and who don't really understand it and don't appreciate it. So there's something very gratifying to come to a place where everybody already gets it. Conversation just starts immediately at a different level.
Yeah, that's definitely on my list. I wanna definitely make it out one of these years, hopefully next year. And yeah, I think it's been amazing, the people that you meet in the fire community. Everybody has been welcoming and genuinely nice. So that's one thing that I love about our community, aside from all the amazing personal finance tips and life-changing advice that you get. It's
it crosses barriers that we don't typically cross in our day-to-day life, whether they're their age or race or gender. I mean, it's just the FI community in general is an amazing community in that regard. And Chautauqua is, I'm fond of saying the only group of people who don't come to Chautauqua are bigots. Because if you're a bigot, you're not going to want to be at Chautauqua, because it's a very diverse experience. But that's literally the only group who don't come.
Yeah, and I'm okay with that.
And I'm okay with that too. And by the way, that's not political. I mean, we have people who have come who are very far on the right side of the political spectrum, and those who've very far on the left, and everywhere in between. But yeah, the only people who don't show up are bigots.
I love it. Yeah, let's leave it at that.
I'm all right with that.
Well, so to conclude, I think it'll be important to we covered a lot of ground and we kind of touched a lot of bases. So I think what I want to conclude with is leaving the audience with your 9 basic principles that you have on your blog, and this is something that I think you wanted to make sure your daughter understood. Is that right? Because you realize that she's not very into personal finance like we might be, and we are the weirdos, not them.
Absolutely.
So you realized, okay, we got to make it simple, and just you created these 9 basic principles. So I'd like to go over them and leave the audience with that. And then if you want any thoughts, you can chime in anytime.
Yeah.
So
go for it.
The first one is avoid fiscally irresponsible people. Never marry one or otherwise give him access to your money. And I love how it said him. Because you're writing for your daughter.
Right. I mean,
got you.
Yeah. So it's important to remember that everything I write is aimed at my daughter. And I'm fond of saying I've only ever tried to convince one person of this, and that's my daughter. And the fact that other people have found it useful and helpful and life-changing is very gratifying. But by the same token, when people come along and want to argue with me about it, I don't care. if what I say doesn't resonate with you, that's fine. Don't do it.
Right.
Go do whatever does resonate with you. I'm not the least bit interested in trying to persuade anybody of anything other than my daughter. And by the way, job done. She is solidly on the path. She's still not as interested in this stuff as we are, but she knows what she needs to know to make it work for her. And that's what the simple path is all about. If you get a few simple things right, then you don't have to spend all your time worrying about money. and
Yeah.
thinking about money. I like thinking about money, and you like thinking about it. Maybe a lot of our listeners do. But to be successful, you just have to get a few things right.
Perfect. Yep. The second one here is avoid money managers. It's your money and no one will care for it better than you. The third principle here is simple, avoid debt. The fourth principle here is save a portion of every dollar you get. So paying yourself first. The fifth principle, which I love, is the greater the percentage of your income you save and invest, the sooner you'll have FU money. Try 50% with no debt. This is perfectly doable. 6 is put your money in the Vanguard Total Stock Market Index Fund, or VTSAX. This is the fund you already own. You're talking to your daughter, so just keep adding to it. 7, realize the market and the value of your shares will sometimes dramatically drop. People all around you will panic. They'll scream, sell, sell, sell. Just ignore this. Even better, buy more. Number 8, when you can live off the dividends of VTSAX that VTSAX provides, you are financially free. And number 9, the less you need, the freer you are. So those are the 9 basic principles. And I think that just like your daughter, living based off of that, I think the audience can totally, that's all you really need, I think.
Yeah, and in many ways, the blog and the book is just an elaboration of those concepts.
Mm-hmm.
And not surprisingly, there are several of them that I've gotten pushback on, because this is a path that just doesn't resonate with the average person. So, you save 50% of your income to the average person who doesn't have any context for this, and their head explodes.
Right.
Yeah. So
All right.
you say it to the average FI person and they say 50%, I'm shooting for 80%.
Overachievers, of course.
Exactly.
All right. Well, JL, thank you so much for joining. I want to end with just a question. If there's anything that you have coming up or you'd like to share with the audience, anything new or interesting, by all means, we'd love to hear it.
Well, so anybody who's interested in the blog can go to jlcollinsnh.com. That's the blog, and there's a link to the book on Amazon there if they're interested in the book. The only thing that occurs to me is I was just, and this is the first time I've mentioned this in public. It's literally a conversation I just had a couple of days ago with Alan and Katie, my Chautauqua partners. As we talked about a moment ago, we're not doing Chautauqua this year because of COVID. But they had suggested maybe we do some mini kind of Chautauqua online for the 4,000 people who are on the mailing list. And even if we're doing Chautauqua, because we have so few available slots, most of those 4,000 would never be able to come. So if any of your readers, or your listeners rather, are interested in getting a taste of Chautauqua, sign up on the mailing list, and we might well be doing. Can't promise it because it's still just a thought at the moment, but sometime this year we might be doing something virtual that won't be the same, but it'll be a taste.
Yep. No, I highly encourage it. Like a lot of things in this world nowadays, it's going virtual, which is exciting. Yeah. And I'll be signing up, so I hope everybody else does too.
Well, good. Well, don't sign up unless it really appeals to you, but if it does, yeah.
Well, JL, thank you so much for joining the show once again. It's a pleasure, and I hope the audience got just as much value from this show as I did. So thank you again.
Well, I appreciate the invitation, and it's been a lot of fun chatting with you. And like you, I hope your listeners enjoy it as well.
All right. Take care, JL. So I hope this episode was as useful to you as it was for me. If you would like to help the show, here's how you can do it. First, subscribe and leave a review on any platform where you listen to the show. This will also enter you into our giveaway where I announce a winner each episode. Second, share this podcast with a friend. Lastly, you can help me continue to bring you amazing content by becoming a supporter of the show. There'll be a link in the show notes below. That link takes you to anchor.fm/inspire-to-fire/support, and even a small contribution helps. As a thank you, I will send you all my fire resources and give you a shout out on the next episode. Until next time, thank you for listening and have a great day.